Well, welcome to the equity crowdfunding series. My name is Rick Leinbach. I'm with Startup Portal. And today we're going to talk about equity crowdfunding and give you examples of what it is, what it means. And today we're focusing on technology and some different types of agreements in equity crowdfunding. With me is Nick Bartell and Dustin Otis, our summer marketing media intern. So we're here to put together a little presentation. If you watched last week's seminar, it's a little similar. However, we focus on agreements today that we didn't talk about last week. So as I mentioned, my name is Rick Leinbach. I'm the founder of Startup Portal and Carrollton Partners, which we do outsourced accounting and finance services. And part of equity crowdfunding is sort of a derivative of companies be able to go to the Securities and Exchange Commission to raise capital. So that's where we fit in this element of equity crowdfunding. And Startup Portal is a cloud-based platform utilizing today's software tools to provide an outsourced accounting and finance element to a business. Particularly, we work on the financial plan and really put you in position to raise funding. And we have tools here at Startup Portal for co-working, podcasts, software resources, and our staff range from myself as a former chief financial officer to accountants, bookkeepers, and other advisors in business. So hopefully you enjoy this presentation, get a little bit out of it. Just to start with a couple examples, Laminar Scientific has used equity crowdfunding to raise $112,000 through 82 investors. And their product is a breakthrough wave energy where you're putting this in the ocean and it's generating electricity, from solar and waves and really technology of today. Their target raise was $50,000 up to $250,000. So they're close to the mid-range of that raise. And what they did was used an agreement called a SAFE agreement, which is a future equity. And we'll get into that in a little bit, but it allows you to raise capital without having the negotiation up front of what your company's worth, et cetera. And when I see $112,000 raised for something, a product like this, it's usually for sort of a test product or a prototype. Now, with this, they've also raised $200K from friends and family outside of crowdfunding. In some cases, friends and family can be within crowdfunding. We'll talk about that in a little bit. And then they put a valuation cap on the investment, meaning that if you're investing in this today and the company is worth $20 million 2 years from now, your value that's locked in is no more than $6 million. So you get the benefit of that $14 million increase in capital. Another example is Nexvolt. They've actually had 3,600 plus investors and raised about $3 million, $800 per investor. Their product is a powered battery technology. And they're looking for up to $5 million, which is the cap for equity crowdfunding. And the minimum investment was $250. So you can see this, and the investments come from the crowd. In this case, a pretty sizable crowd. And they had previously raised about $80,000 in the past. One element to this is, unlike the last example where you had a valuation cap, here there is a valuation of the company before the money comes in of about $35 million. So that's something that we'll talk about and show you examples of other valuations in the process. Now, crowdfunding, does it fit what you're doing? Traditionally, you would go to the bank, go to private equity, have a discussion, have a meeting, and vet through which banks or private equity groups fit your business model and fit their business model. Obviously, banks are risk adverse. Private equity is not risk adverse. They just need to make sure you have the right model to go in their portfolio. The equity crowdfunding allows you to actually fractionalize that private equity, so you can have the crowd come in and be part of your scenario, your opportunity, your engagement. Even if it's a prototype element, it allows you to really get the prototype complete. Unlike probably 20 years ago when people were putting on a PowerPoint slide to show the future technology when they're raising the capital. crowdfunding is regulated. Similar to stockbrokers, crowdfunding is regulated by FINRA, who regulates the stockbrokers. There are about 60 portals that are registered with FINRA and approved, basically to be a portal. And essentially, equity crowdfunding allows you to raise up to $5 million within a 12-month period of time. There's a next level of crowdfunding called Reg A, and that allows you to raise up to $75 million. Typically, most companies will start with the equity crowdfunding of the CF, and if they can go up to the next level of Reg A, or I've actually seen public companies use Reg A as part of the crowdfunding investment. As you can see, various different crowdfunding companies and portals, each of them have their own business model. Equity Door is real estate. Start Engine is a plethora of everything. Mainvest is restaurants and breweries. So with that, the crowdfunding is broken out different, I want to say securities or vehicles that you can actually raise money. Typically common stock, equity ownership, share ownership. It is, majority of the agreements or a sizable part of the agreements. Safe agreements, which we'll talk about. You can also debt and revenue share, which last week's seminar that's on YouTube is available to look at. We talked a little bit about rev share and debt last week. And then safe agreements. It's simple agreement for future equity. And really what it is you're participating in an agreement of raising capital, but the future equity value is triggered at some point in time. The trigger could be a company now raises $5 million. Everybody's triggered and converts over at that $5 million level. Typically, the folks that have safe agreements, that $5 million level would have a discount to it. So that's where you pick up a little bit of a discount and allows the company to raise capital, significant capital down the road without having to worry about when you put your safe agreement in place, what the value is. So you'll get a discount of that and participate in the upside, because if you recall earlier, we talked about that valuation cap. So the safe agreements typically require a trigger. However, there are caveats where safe agreement may never be triggered. The company may actually do very well, not need another dollar from anyone, not need to raise the $5 million. So the agreement may be stuck in limbo. So really, as we go through this process and you're looking at technology and safe agreements, things like that, think through that process. I have heard that certain groups like private equity are not fond of safe agreements. They'll do what's called convertible debt, where you have a loan to the company that converts out at the same aspect of a trigger feature. Let's say you raise $5 million. So they're the different types of crowdfunding. Now, just to give you a semblance of what goes on in the crowdfunding world and how significant it is, and it's developing. It really is coming from California, New York, Texas, but really coming across the United States. In this chart, you'll see that technology is, and we're just taking a sample of the month of May, of actual crowdfunding deals that were started that month and have raised capital to date. So you can see that 35 deals raising $15 million for technology, on the average about $467,000. The interesting part is, if you look to the right of the schedule, the valuation of these companies, which valuation would be if someone had an investment in common stock, or the valuation cap, which is, say, a safe agreement and convertible debt, caps out at a certain number. They're both at around $19 million. So in the world of private equity and valuations for technology companies, it's high, but it's probably not unrealistic. When you get into some of the other groups here, where you look food and beverage, consumer products, the agriculture, the valuations tend to be higher in crowdfunding. So from the standpoint of someone looking to raise capital, that can certainly be, I guess, more advantageous, that you're taking in more money at a higher value. However, and my personal opinion is, if you have a balance of crowdfunding where your valuation is more balanced with what investors would like to see for return, I think the industry as well as companies will do much better in the long term. I will say at the economic situations change where companies need more and more capital, those valuations are probably going to come down as folks need capital and probably willing to do it for a less than expensive price. Now, with that said, equity crowdfunding does get a little bit ahead of itself in valuations. The example I have there on biotech companies, the company itself has raised $175,000. However, they're valuing themselves at $124 million on, in a valuation. Not likely going to sustain 124 million if you need more capital in the very near term. So with that said, 175,000 in the biotech industry will probably get you about 1 month of activity, realistically, without even hiring people. So it feeds funding. And so equity crowdfunding may not be the best fit when you have an industry that needs additional significant funding. And that's just a good example of things that I want to say that a little bit off track in equity crowdfunding. Now, with all of this, a couple of things I asked you to just as you're thinking through it. The old plan, test, advertise. We'll talk about test the waters in a moment. I'll give you an example where you can, in equity crowdfunding about a year ago, they changed the rules to allow you to look at, hey, if I want to do equity crowdfunding, can I go out and see what people think about my crowdfunding effort before I pull the trigger? So now people can do a test the waters. We have been told by some of the portals that we've talked to is that test the waters is just a way for people to move it up faster, get things going. But the reality is you can use it as a tool. And then the marketing element to crowdfunding, the media, Facebook are factors, publicity, local publicity are factors in really getting the crowd behind you. It is a strategy to really take friends and family, market it locally, get people energized, and, get out there and really tell your story so people want to be part of it. And then obviously your purpose of funds. As we saw earlier, they likely use the funds for a prototype or to build to the next level. One element to that is that, let's say you have a prototype you want to build of about $50,000 and you're running a crowdfunding campaign and all of a sudden you hit your goal on the crowdfunding. Certainly the crowd is excited. One of the things I would suggest as you look at it is, can you take additional funding for the future to give you additional runway? So I would say if you run strong and people are very happy about it, and you can take additional funding, hard not to, and it may help you in the long run to give you the ability to plan further. So always plan, design the sort of the runway to success. Now let's take another example of a crowdfunding that in 4 days will end, and this is Futurecardia, and they're in the healthcare heart monitoring business. They've raised to date $2.6 million from 2,100 investors. That's $1,200 on the average per investor. When you get to that level, $1,200 is probably realistic. Some larger fundings have, some portals require people to get significant funders to back it to get it started. So that, but here I think with the significant number of investors, the average is probably right. They have a $20 million valuation. Only takes $250 to participate, and they're experienced in the crowdfunding world. They've already raised $3.3 million in equity crowdfunding. So by doing the second crowdfunding, likely they're going to use that as their future vehicle to raise capital. In this case, likely they've done a equity crowdfunding series in the prior year, doing one this year. They could step up to the next level and go to the Reg A crowdfunding next year. In crowdfunding, there's no rule that says, hey, if you do a start engine crowdfunding, you can't, and it ends, but, and usually they're about 6 to 8 week periods of time. You can actually jump to WeFunder, which is another portal, for another 6 to 8 weeks of time, as long as you, in that 12-month period, don't hit the $5 million cap. So we wish these folks luck. Now, this is an example of a crowdfunding, DAC Electric Motors. They went out, valued themselves at $10 million, had a $100 minimum investment, did a safe agreement, and came up with just $1,000 raised. Now, with that said, they didn't reach their minimum goal. And obviously I don't know what they did in the front end to market it, get friends and family. But when you launch the crowdfunding, you really want to have the energy behind the crowd, at least your local crowd. Here, likely it was put out there to see if people will jump on. And it makes sense, probably when they did it back last year. Today, I'd suggest do a test of waters, especially with something a little different, as an electric motorcycle. But here it's just part of the planning aspect of what you're doing. Here's an example of Blueprint Diagnostics. They did a test of waters campaign, and they've got 19 people interested, committing to around $45,000, and they're looking for $90,000 to $1.5 million. In this case, they're below their minimum goal. So from the standpoint of looking at their product, their service, and their local community, they or local stakeholders, let's say, they probably will likely need to find a significant stakeholder, maybe a strategic partner to put funding in, as well as honestly get networking, find folks, get them excited about your product, whether it's blogs, media, etc., and really get the energy out there to see if this can take. Alternatively, and there's nothing wrong, especially if you're testing the waters, with having a roadmap to talk to different private equities and looking at their business model to say, okay, what fits with what we're doing. One element with the crowdfunding is just looking at your decision making. Make sure you're comfortable with shareholders, debt holders, because they're there, they're going to send you emails and how we doing. The research the portals. All the portals have different facets and sort of business models themselves. Even fee structures are different among them. And your typical fee could be anywhere from 3 to 8% for the portal to get the fee, and then other fees if you're spending money on advertising, etc. One of the things we'd like to do is just do comparable companies that have done crowdfunding to see what they've done, to understand what capital they've raised in what industry. As we showed you from the chart earlier, there is a wide range of activity among many different industries. The marketing element. Critical you look at marketing suggestions, just for the fact that the more marketing you have, likely the more costly it is. So you have to be cautious, get an education, find the right marketing folks that know the industry. And obviously, if you look at crowdfunding, even the seminar today, when we're talking about crowdfunding, you may see that come up on Facebook, or different opportunities come up on Facebook. And the last point here is, and I profess this a lot, if you have a prototype, if in round one you're just raising say $50,000, when you're doing round one, always think about, are you going to need a round two, and plan accordingly. So crowdfunding may be great. You may only need 50,000 for your prototype, but maybe 10 million down the road, and you may need private equity. Just think about, will private equity want to basically take me and 1,000 shareholders with me? So it's just plan accordingly. So in a bit of summary here, talking about equity crowdfunding, it is an alternative funding opportunity. It's not the bank. It's not basically private equity. And it's also not some of the funding solutions out there that are significant cost at 40% a year, where they just take cash every month, especially if you're an operating business. So it's got some value in where it fits. The ability for test the water. Great feature that came out about a year ago. Equity crowdfunding has only been approved since around 2015. So it's a nice way to really see if it fits you without exposing yourself to accounting, lawyer, marketing fees, video fees, etc. So and then you can raise up to $5 million, as we saw from a couple examples there. It's actually being done. And there's flexibility in the way deals are designed. It's not just straightforward of a debt agreement. You got common stock. You've got the safe agreements, convertible debt. So various ways to raise capital. Downsides: cost of capital is much more expensive than traditional financing, no doubt about it. what happens if it doesn't work, as we saw from the one example. In that case, the crowdfunding program shut down, and their cost was what they'd spent to get it up and running, which now is alleviated potentially by test the waters. Valuations can get crazy. We saw 123 million for a biotech company. There is reporting to the SEC. It's not significant, but it's annual for the first 3 years after your crowdfunding, where you have to provide your financial statements and essentially give your shareholders an update. And then be comfortable with shareholders. The burden of the investor management is there. You have to communicate, do newsletters, keep the crowd excited. And they're a part of your team now, no doubt about it. So what are we doing to start a portal? Well, our expertise is really helping you with the entrepreneur route, finding that solution for capital. A lot of times it's identify the right solution or seeing what alternative fundings are out there. And then we're also building an investor, sort of route where we can bring the entrepreneurs to investors and really provide that, what I would say, fair compromise of opportunity for the future. So look for that from us at Startup Portal. And obviously, if you're in the Maryland area, we're actually based a storefront in Westminster, Maryland. We also have a location in Western Maryland, in Cumberland, Maryland, and provide our financial services and co-working, etc. So with that, we have 2 more series of the crowdfunding next 2 weeks. Next week, we're likely going to break down and drill into an equity crowdfunding process, look into a Form C, which is what's required to report through the SEC, show you how it looks at the SEC and some updates with the annual reporting. So just get into the weeds a little bit and provide you that insight about equity crowdfunding. Well, with that said, we appreciate you watching the seminar. Hope you learned a little bit. And like I said, if you're looking to do a crowdfunding, reach out. We'll be glad to provide you examples that kind of show you what others have done. And we'll see you next week.